All right. Thank you for being here this afternoon. It is a privilege to welcome you on behalf of the Wiedenbaum Center on the Economy, Government, and Public Policy. My name is Andrew Reeves. I'm a professor of political science, and I'm the director of the center. Before we begin, I want to acknowledge that today is Veterans Day. It's a moment to pause and recognize the men and women who have served our country, many of whom continue to serve in our communities, universities, and public institutions. We all owe them our gratitude. Today's event is a special one, and it brings to mind our founder, Murray Wiedenbaum. Murray was a renowned economist, advisor to presidents, and of course a longtime WashU economics professor. Murray believed that scholarship should never remain confined to the ivory tower. It should engage directly with the ideas, the policies, and practices that shape our civic and economic life. That mission continues to guide us. At the Wiedenbaum Center, we support rigorous social science research, and just as importantly, we work to bring that research into the public sphere. Our goal is to serve as a bridge connecting scholars, policymakers, students, and citizens in conversation about the issues that define our shared civic life. Today's discussion reflects that mission at its best. We meet at a time of economic uncertainty. As the longest government shutdown in U.S. history is coming to an end, when questions about growth, inflation, fiscal responsibility, tariffs, and public trust are again at the forefront. These moments remind us that economic policy is not purely abstract concept. It shapes daily life in every household and community across the country. To help us make sense of it all, we're joined by two remarkable economists who bring deep academic insight and extensive real-world experience. They'll help us, along with our moderator, to think clearly about where we are, what's working, and what the next chapter of U.S. economic policy might hold. All right, I'm going to briefly introduce our panelists. First, we have Professor Steve Fazzari. Steve is the Burt A. and Jeanette L. Lynch Distinguished Professor of Economics, as well as Professor of Sociology. He also serves as a resident fellow of the Wiedenbaum Center. At the end of this academic year, Steve will conclude his remarkable and distinguished 43-year career at Washington University. During that time, Steve has done just about everything, including reestablish the Department of Sociology. Among his many, many accolades, Steve received a Missouri Governor's Award for Excellence in Teaching, as well as a Distinguished Faculty Award from Washington University. His research explores investment, economic growth, and the macroeconomic effects of inequality. Second is Chris Varvaris. Chris is the Regional Director for the Americas at the Economist Intelligence Unit and a Senior Fellow at the Wiedenbaum Center. A leading macroeconomist, he founded Macroeconomic Advisors in 1983 and later served as co-head of U.S. Economics. He began his career on the staff of the Council of Economic Advisors under, you guessed it, Murray Wiedenbaum, and most recently served as Deputy Assistant Secretary for Macroeconomic Analysis at the U.S. Treasury. His work spans forecasting, risk assessment, and fiscal and monetary policy. Finally, our moderator is Elizabeth Pippert-Larson. Elizabeth is the Associate Director of the Wiedenbaum Center, where she leads budgeting, research programs, partnerships, and public events connecting scholarship to policy. She's an attorney and member of the Missouri and DC Bar Associations. She also serves as treasurer of the Community Advisory Board for St. Louis Public Radio. She lives in Fox Park with her family and is a devoted and long-suffering Chicago Bears fan. Please join me in welcoming our fantastic faculty.
They are currently doing well this season. Thank you all so much for being here, and Chris, thanks for making it. Please go ahead and take it away. We are thrilled to hear your insights.
Great to be here. Thank you very much. And the ghost of Murray is in the room for sure today. We'll see it. So let me my job is to kind of set the table, really, so we can get a lot of meaty commentary from Steve. So I'm going to do that. So obviously we have a smorgasbord of policies that this administration has laid out. I've called it an economic agenda. The first one, the 900-pound gorilla in the room, is the tariffs. So I call them America First tariffs. The administration is really aimed, there are two goals here. One is to bring manufacturing jobs back to the United States. There's some national security goals here as well, and also to raise revenue. And the weight that is put on those two goals behind the tariffs shifts depending upon who you're talking to and when they are talking. And we have both broad tariffs that are applied to all countries or to countries and all goods from those countries. And we also have sectoral tariffs like on steel and aluminum and pharmaceuticals and cars and so on. The second key element of the administration's agenda is to reduce legal and illegal immigration and to deport undocumented or illegal aliens who've made it to this country. Now, this has important implications not only socially but also economically, in that, as we know, economic growth is driven by growth of the population, the working age population, investment and productivity. So to the extent that this leads to a slowdown in the growth of our labor force, it does have implications for the overall growth of the United States. The third major piece, which is really cuts through a lot of what the administration is trying to do, is to implement a type of industrial policy. And here, this includes taking stakes in private companies, imposing export controls and fees, as well as arm-twisting governments and private firms to increase their investments in the United States. Another key element is to expand energy production, both gas and oil, and to allow greater use of coal. So there's some unwinding of Biden-era and Obama-era restrictions on the use of coal. Of course, the One Big Beautiful Bill Act extended the expiring Trump 1 tax cuts and added some new tax cuts for excluding tips and overtime, and increased the limit on state and local tax deductions that previously was in place. And as well, there was a goal to shrink the size of the federal government. You'll recall the controversy around DOGE early in the administration and the drastic cuts that were made in the early days of the administration. Another key element is to reduce regulation. And of course, this is something that was always near and dear to Murray Wiedenbaum's heart and to the early days and the founding of the center, when it was known as the Center for the Study of American Business. But of course, Murray took a very sensible, rational, pragmatic approach, which was, let's use cost-benefit analysis and not just look at the costs of regulation, but also look at the benefits of regulation. And so I wish he were here today to give his views on currently what's going on. Another element has been, and this is sort of unofficial, but jawboning the administration, jawboning the Federal Reserve to lower interest rates in the hopes that that would stimulate economic growth. And of course, the way that this is being done by trying to remove Federal Reserve governors and put partisans on the Federal Reserve Board is something that threatens Federal Reserve independence, which most, I'd say, impartial observers think is a bad idea, given that there's so much evidence to suggest that independent independent central banks do a much better job of controlling inflation than those that are under the direct influence of the executive. And finally, they're attempting to remove the Biden-era IRA subsidies for the green transition, and this has direct implications not only for climate policy, but for some of the very significant investments that have been ongoing in terms of alternative energy sources, which have benefited from those subsidies, as well as for battery production and so on. So that's the smorgasbord. We really don't have time to discuss all of them, so we're going to focus really on a few of them. The first that I want to get to is the tariffs. So this chart, the red line shows the weighted average tariff rate that uses the tariffs applied to countries or to commodities based upon their share of imports in 2024. So it's a fixed weighted average of the tariffs that have been announced. And what you should notice is that every right angle turn in that line represents some announcement that was made of a new tariff that was either put in or taken out or paused or put back in or taken out or put in or taken out. So not only are we at the highest tariff rate, even though we're not at the exact peak, but the highest tariff rate since the Smoot-Hawley tariffs around 1930. But the chaotic rollout of these tariffs has created a huge amount of uncertainty, and we have some measures of economic uncertainty or trade policy uncertainty, which spiked to record levels in the early days of these announcements and have bounced around, but remain somewhat elevated. The blue line represents the effective tariff rate that firms are now paying. So this is customs duties collected divided by goods imports, converted to a percentage rate. And you can see it's quite a bit different than the announced, or what we might call the statutory tariff rate. And there are a couple of reasons for that. One is firms have been pretty good, pretty agile at reconfiguring supply chains quickly in order to avoid the highest tariffed geographies or the highest tariffed goods. And this is something that we probably, if there was one thing that was good that came out of the pandemic, it was that firms just figured out they needed to be a whole lot more agile in reconfiguring supply chains. And so I think one of the benefits of that is firms have responded to the tariffs quite significantly. Another thing is that there are free trade zones where imports can come into the United States but not face the tariff rate until they leave that free trade zone in the United States, and that probably accounts for a couple of percentage points difference between those two lines. Okay, so that's sort of how bad that is. So what are the direct effects of tariffs? So it's like a tax on consumers, because ultimately firms will pass these forward into final goods prices, and so it acts almost like a sales tax. It raises the cost to consumers. They'll slide up their demand curve and want to consume fewer of those goods, substitute to other goods perhaps. But then also domestic producers will take advantage of the higher prices charged by their competitors, and so we'll see sympathetic price increases from domestic producers. So it's not just the tariffed goods that will see price increases, it will be domestic production. To the extent that we produce those goods, we'll also see price increases. Now, there are some possible offsets that we do think about. One is there can be domestic margin compression, so firms won't pass forward to consumer prices the full amount of the tariffs. There can be foreign margin compression, and we saw a little bit of this with Trump 1 tariffs, where foreign producers actually took smaller margins so that they wouldn't lose as much market share in the United States. The other thing that would typically happen is that the dollar exchange rate would rise as a result of the fact that if imports to the U.S. shrink, we're sending fewer dollars out into global markets, and that allows for the dollar to then appreciate. But the opposite has happened. Since the tariffs were announced, the dollar has fallen anywhere between 7 to 10%. And so instead of getting that offset, we're actually getting something that's working in the opposite direction that ultimately will also contribute to higher U.S. consumer goods prices. Uncertainty effects are also a big part of this. I did mention that there are measures out there of the degree of economic uncertainty or economic policy uncertainty, and these spiked to record levels both in the United States and globally. And the expectation was that this would lead firms to sort of, as if you drive into a fog bank, what's the first thing you do? You slow down. And so that lack of visibility of exactly what was going to happen was anticipated to lead firms to pull back on investment, either scale back or delay decisions, but also to reduce hiring, not knowing exactly whether the demand was going to be there for their products. They might want to cut back on hiring. And it's possible both of those things have happened. We don't have really good measures of this yet. I think studies over the next few years will help us to tease out how important those effects have been. Then there can be financial markets effects. Every time Trump announces new tariffs, the stocks tend to go down. When the deal was just recently announced with President Xi to have a year-long sort of truce, the stock market rallied. So there are financial market effects that also spill over into some real economic effects. And then, of course, there are the positive revenue effects, which we could see lead to as much as $300 billion annually in additional revenue. So that's, if you think that justifies, well, anyway, it's something that happens. Okay, so let's just see about, well, lower deficits are good, other things equal, so we can agree to that. Okay, so what this chart shows is just how it was that, so this helps explain to some extent why the tariffs haven't led to as much inflation as we initially thought might happen. So if you look on the far right of this chart, that is the direct contribution to the GDP price index in the second quarter, the annualized increase in GDP price index of that increase in tariff revenues. The purple bar next to it is a negative, and that is some reduction in other costs, which offset some of that. The sort of plum-colored negative bar there is the compression in margins, which would normally be a positive contribution to the rise in the GDP price index, but the compression of margins actually led to a negative. And then the bright blue bar there is the contribution from rising labor costs, which normally would have been about double that amount. So the combination of those last two bars I just described, the plum bar, instead of having a positive contribution from margins, having a negative one, and the light blue bar, and not being twice as large, amounted to about 1.9 percentage points of drag or restraint on the GDP price index compared to what would have otherwise occurred. And that almost completely offset the 2.2 percentage point contribution from the higher tariffs. So that's good, at least in the short run. The problem is neither of those things can persist. Firms will restore margins, and that will lead eventually to not only the normal margin expansion contributing to prices, but probably even a catch-up effect. So our own forecast at EIU is we're still headed to some pretty rough sledding around, later in this quarter. Of course, with the shutdown, we're not seeing the economic data, so we don't really know what's happening. But later this quarter, next quarter, probably a pretty good pop in the inflation numbers. So that's kind of the tariff story. And of course, it has not only inflation effects, but those inflation effects lead to a pullback in demand, which can then also have real effects on spending in the economy and slow down economic growth. Immigration. So this is a set of numbers that come from the Congressional Budget Office. The red line is total population growth. The blue contribution is the net births, it's births minus deaths in the resident population. So that's the population growth we get from people who are already here. The green bars piled on top is the contribution from immigration. And as you can see, it's a really important part of the growth of our country for many years. And what we have going forward is a resumption. You can see there in 2025 is the smallest contribution of immigration. That estimate is probably a bit higher than was actually going to occur in 2025. And the CBO's projections have them kind of coming back to a normal level there of roughly 1 million per year. And if the Trump policies continue, it's highly unlikely that we're going to get to 1 million a year. It's probably going to be something closer to 500,000 or less. And that means much slower growth of population, starting much sooner than otherwise would have happened. And that will lead to slower overall economic growth. Okay, and then just quickly on industrial policy before I turn the floor over to Steve. And this is where we've seen a convergence of both left and the right in terms of having government involvement in the economy to achieve goals that the people who are running the government at that time would like to achieve. We did see it certainly in Biden with the passage of the CHIPS and Science Act. That was, of course, bipartisan because it was something that we felt for national security reasons we needed to have more of that good stuff produced here. But it also is in the IRA, which had all the green transition subsidies in it, which, of course, the current administration is no fan of. Currently, the administration has taken a 10% stake in Intel, a 15% stake in a materials mining company, MP Materials, stakes in Lithium Americas, Trilogy Metals, and U.S. Steel through that so-called golden share. So very much being involved in the economy. And this is something I think Murray would not look very fondly on because the government sort of telling, managing the economy to that extent was certainly something he was not a fan of. We did see it with the auto bailouts during the Great Recession when the government took stakes in Chrysler and I think GM, and so that's another aspect. So both parties have engaged in this through time. Tariffs are also a form of industrial policy because we're mucking with the degree of imports of steel and aluminum or chips or exports of chips. So that's another form of industrial policy. And of course, this, as I mentioned, the arm twisting to get foreign governments, this goes beyond the usual Chamber of Commerce sort of thing. Come and invest in our city, come invest in our country. This is actually it's a type of governmental extortion, I guess, in order that if you want this lower tariff rate, you must invest in our country. Okay, so that's really some of the key things that I wanted to point out. And then Steve is going to add his own comments on this.
Well, thanks, Chris. That's very helpful to have a summary of what's been happening. It's been quite an interesting time. Just something popped into my head just as I made that comment, which is during the Great Recession, I made this kind of analogy. I said, if I studied tornadoes, I don't want to really see anybody's barn get blown up. But if it's going to happen, I want to watch. And in the economy here, we've really been on quite a roller coaster ride with the Great Recession, which was surprisingly deep from the point of view of most economists, I would say. I was maybe a little bit more ahead of the game on that one. The pandemic, which was really very disruptive, and now the most unusual economic policies of, I don't know, certainly my lifetime, which is approaching 70 years. So it's been an interesting time. What I want to do just in a few prepared comments, and then we'll just go to the fireside chat, so to speak, fire notwithstanding up here, and your questions from the audience, is just to talk a little bit about where we thought the economy might be, where it actually is right now, given these policies. So I'm going to rewind the clock back to the early part of the Trump administration. Maybe a good date would be Liberation Day, which was April 2nd. And around that time, actually, Chris and I had lunch. And we were, sitting around talking. We really didn't know what was going to happen, but everything looked really quite risky and very strange. So one of the big concerns there was that it seemed like with the tariffs on China that the administration might almost literally shut down the supply chain with China, which of course we've come to rely on quite extensively. There was a big fear that we would get retaliation of other countries against U.S. exports, and that would hurt our economy. Deportation of large numbers of workers, in particular in key sectors like the agriculture and housing. Massive cuts in government spending, which would lead to lost incomes, as we've seen in the government shutdown, and lost contracts for people that provide services to the government or military equipment or those things. absolutely massive uncertainty, just massive uncertainty. Chris mentioned it, I want to highlight it. Maybe the biggest risk that we saw. And I remember across the lunch table, we were talking about this. In some sense, it seemed kind of hard to think that we could avoid a recession. Well, 7 months later, early November, as Chris mentioned, to a large extent, or to some extent, the administration has backed off on the tariffs. The tariffs are still higher than they have been at least since the 1930s, but still lots of uncertainty. But the effective rate is 11% now in terms of the data that Chris showed us. And tariffs are about 17% of the U.S. economy. Imports are about 17% of the U.S. economy. So you multiply 0.11 times 0.17, you get a pretty small number in terms of what the overall impact would be, say, on prices. In some ways, the retaliation from other countries has been limited. China being somewhat of an exception there. Maybe this is a bit surprising, but it seems like other countries have kind of taken the view that the way to work with the Trump administration is to kind of play nice, at least on the surface, flatter the president. It seems to be a strategy that they're taking to try to get favorable treatment. Now, what that means in the long term could easily be that other countries say we really can't rely on the United States as we did before, and we should decouple our economies from the U.S. You see some of that already happening, but at least in the short term, we've seen less retaliation than we might have expected. The deportations are slower than the administration claimed they would be, but they're still significant. And on federal employment, I just looked at the numbers on those. We don't have the most recent numbers for September and October, but as of August, employment in the federal government was down by about 100,000, which might seem like a big number, but there's a lot of people working for the federal government. That's about a 3% drop in federal employment, but it's less than 1/10 of a 1% drop in overall U.S. employment. So that, despite the kind of the theater of DOGE and the very specific disruptions it put in very particular places, in terms of the macroeconomy, that hasn't been a huge effect. So what are the results that we see, as of this point? Well, job growth overall was pretty good through April. It was the U.S. economy was doing reasonably well in the later part of the Biden administration, and that was continuing. The momentum continued through the first part of 2025. But we did see a big drop in monthly job creation, net creation, the difference between the number of people hired and the number of people that lose jobs or leave the labor force. And so that the numbers for May, June, July, and August were substantially lower. This led to the firing of the head of the Bureau of Labor Statistics for not any particular reason except the president didn't like the numbers. And that was controversial and upsetting to economists that really rely on good data coming out of these very professional institutions in the federal government that put together our data. And actually that happened after the July numbers. The August numbers were also really weak, and there was not a lot of pushback on that one. We don't know about September and October if the government reopens. I guess we get the September numbers reasonably soon because the data were pretty much in process before the shutdown. October might be longer, so we'll see what happens. But we still had positive job growth. There was some sense of maybe negative, but quite low. And so the economy did appear to be slow in the labor market. Inflation was, initially fell quite a lot in the second part of the Biden administration from the pandemic peak highs. It's a different topic than today's topic, but interesting topic about why that was happening. And then was falling more slowly, but was falling when President Trump took office. And that reduction has somewhat reversed, that there's some indication of inflation being a bit higher. Chris talked about it some. Other things equal, if you raise tariffs, you expect prices are going to rise. Maybe they didn't rise as much as many people expected, and there was some kind of catastrophizing about tariffs and inflation in this discussion, but there seems to be some effect, and so inflation's been a bit higher. And there is some risk of acceleration, as Chris mentioned. When the economists talk about these things and you hear about this discussion in monetary policy, if you put a tariff on, let's say a 11% tariff on, you expect that to raise prices. Maybe it doesn't raise it by quite 11%, maybe it's 10%, maybe it's 12%, kind of depending on how people look at this. But you expect an increase. But as we would look at this, we'd say this is really a one-time effect in the sense that you go from 0 to, or very low, 1 or 2% up to 11%, and then you're done. And then the prices are higher. So when we think about inflation, we think about that as a continuous rise of prices over time. So as economists look at the tariff effects, they say, well, we could have inflation, the movement from a lower price level to a higher price level taking place over the next couple of years, but then that would kind of mitigate. And so over the longer term, there's less of a concern about the tariffs leading to continuously higher inflation in and of themselves. The bigger concern is that if people get used to the idea, or they start saying, well, I thought inflation was going to be 2%, now it's 3% or 4%, that they start baking that into their decisions when they negotiate wage contracts, when they set prices in advance in various kinds of business settings, and then it kind of gets baked into inflation expectations and becomes self-reinforcing. So, there is a risk on the inflation side, and the news now is not awful, but it's not good. It's generally going the wrong direction. Another factor in terms of the overall economy that's kind of worth mentioning here is that we haven't seen that much slowing in some sense. The labor market a bit weaker. And overall GDP numbers that we have so far through the second quarter of 25 are not too bad. But there's an offsetting factor here that I'm sure you're aware of, and that's what's happening in artificial intelligence and how that is playing out in terms of capital investment. You kind of have to look at different numbers here. Again, we don't have the data. It's going to take some time to get all this out. But there's projections that capital investment spending for artificial intelligence will be $370 billion in 2025. That is about 1.2% of the U.S. economy. Now, that by itself is a pretty significant increase in economic growth. And without that, many analysts say the economy may well have been in recession now, but we have this kind of offsetting effect that's coming from the AI. There's, of course, a fear of that's a bubble. There's a fear that that might all collapse and that we could have a problem. So that leads to the uncertainty going forward. So I want to just stop this discussion, but let me just kind of summarize the big picture that there's been a modest weakening of the economy, but not really a collapse so far. That uncertainty remains. But there is this sense that maybe a bit of a calming sense that despite the inflammatory rhetoric of the administration, that they will back off, especially if they see negative results like the big drop in stock prices after the Liberation Day tariffs were announced. There's really no evidence that the Trump policies have helped on jobs or affordability. When you think about higher tariffs, that's higher prices. When you think about cutting back on the labor force, especially in key sectors of agriculture and housing, that's likely to lead to higher prices. So with the kind of general consensus that affordability played a huge part in the Democrat success in the off-year elections that we just had, the administration has really not done anything in that direction, despite the claims. The president claims that grocery prices are down. There's no evidence that's true. In fact, and the survey evidence suggests that people recognize that grocery prices are up. Energy prices might be down a little. I was thinking about that driving by gas stations the other day. Maybe about 20 cents lower on the price per gallon. Not overwhelming in terms of that number, but recognize that energy prices are set on global markets. So even if the Trump administration manages to increase oil and gas production in the U.S., it's not likely to have a big effect on global energy prices. And actually, in that sense, they're also pushing back, as Chris mentioned, against renewable energy. It's been growing very quickly in solar and wind, and that could actually have the opposite effect. And we're seeing, of course, electricity prices up. So on the affordability agenda, I think the big picture right now looks, again, reasonably negative and a source of frustration. And so my last comment would be, what would Murray Wiedenbaum think? I knew Murray, he was my colleague. I go to the Wiedenbaum Center conference room and look at the picture of Murray and at the blackboard with his ISLM model, in case any of the economists in the room know what that is up there. And I think to a large extent he would be appalled. I remember talking to Murray in the old days about the Center for Study of American Business. And this CSAB, as we called it, had a reputation as being conservative-leaning. I think that's pretty strong that it was. But Murray somewhat pushed back on it and said, we're not political, we're not ideological. We want to just get good research out there and pursue good economic policy. So, for example, cost-benefit on regulation, where he thought that often the government underestimated the cost and overestimated the benefits, and that led to that conservative view. But the one thing Murray emphasized more than anything else was we're in favor of free trade. And even if, when the possible corporate donors to the center would come and visit and say, could you give us some research that would help us justify a tariff or help us justify an import restriction? Because Murray said we always push back against that. And I think that, the way that the administration has approached trade would be very upsetting to Murray, even if he likes some of the deregulation. So I will stop there. I think Elizabeth has a few questions she wants to kick through us, and then we'll move on to questions from the audience.
Thanks, Steve. And thank you, Chris. Thank you. Thank you both for those comments, and there's a lot to digest, and we have an hour to figure out this economy, so let's try our best. I just want to let the audience know, I know we started a little bit late. We are going to leave ample time for questions, and I'm going to let you know when to start lining up at the microphones to my right and my left. So we've talked a lot today about tariffs, and President Trump says that one of the goals of his tariffs policy is bringing back manufacturing jobs, and that's something that he campaigned on in all three of his elections, or actually really in all of the elections he's ever run. So I'd like to talk about that, and is that feasible for tariffs to bring back manufacturing jobs? And then maybe even more broadly, is that even desirable for these tariffs to bring back manufacturing jobs from perhaps a cost-benefit analysis on any way you want to take that question?
So that's a hard one. It's harder than I think it seems on the surface for the following reason. So the reason economists have always promoted free trade is because it's to both parties' advantage to have that trade, okay, for the country or the person. Well, think about it, even if, I don't make my own shoes, right? I'm an economist, I earn a living that way, and then I go pay somebody who makes shoes. And all right, so I don't try to do everything myself. Specialization allows for great improvements in productivity and rising standards of living on the whole. So free trade is a way that we can move towards a more efficient system and improve everybody's standard of living. Okay, so the problem with it is we do have, and we did have, a fairly high manufacturing base in this country at one point. And as some of that was supported by having tariffs, and as we move towards lower tariffs, we knew that we would lose manufacturing jobs as firms relocated outside the United States. And this accelerated in the mid-90s with globalization, and then, but there's always two parts to this. Economists recognize that when you do that, there's going to be winners and losers. Everyone in the economy who pays lower prices for the goods that we're now importing, that are made more cheaply overseas, they benefit. But people who lose their jobs and either have to move or retrain or have difficulty retraining, they're harmed. And what we always said was that the winners should compensate the losers. And the problem with what happened over the successive rounds of lower and lower tariffs and globalization was we did the first part and we completely forgot about the second part. And if you drive around Missouri and you see all these small towns that used to have a manufacturing plant doing this or that or a couple, they're not there anymore. And those towns don't look anything like what they did before. So it was and maybe if that was a conscious social policy decision, fine. But I think the problem was we never really had that debate. And so it makes me somewhat more sympathetic to tariffs than the average economist because we didn't do part two. And maybe it's still time we can do that. But having said that, much of the losses in manufacturing are due to productivity increases in manufacturing, have nothing to do with globalization, probably the majority. So tariffs will, around the edges, bring back some manufacturing jobs, but it's not going to lead to a significant difference in the number or share of manufacturing jobs we have in the United States.
Mm-hmm. Mm-hmm.
I really don't have that much to add, but of course I'll say something anyway, which is again, just what do the data show? So we had something like 30% of, maybe 35, 36% of U.S. employment in manufacturing at the peak in the post-war era, probably is peaking in the late 1950s, early 1960s. That number is now 8%. And so we've seen this long downward trend. And what's been happening since Trump took office? It's continued to go down. The manufacturing jobs are lower now than they were a few months ago. And it's happening. Another factor on tariffs is that on the one hand, it might be helpful for certain kinds of sectors if they get some protection from foreign competition. On the other hand, a lot of the inputs into manufacturing are imported. I noticed an article in Bloomberg a month or two ago say that aluminum prices in the US are 50% higher than in Japan or Europe. And so we're having, it's really a kind of double-edged sword. And I think the one place where I'm kind of with Chris, maybe a little bit less of a free trader than Murray Wiedenbaum or the typical economist, in the sense I think we did learn in the pandemic that stretching global supply chains to eke out that last little bit of efficiency might not always be the best strategy, and that having more domestic, maybe a more robust domestic supply process, certainly in certain critical industries, personal protective equipment becomes to mind right away, might be a kind of a good insurance policy, even if it's somewhat more expensive to do it that way on a month-to-month, year-to-year basis. But in the broad sense, the idea that we're going to see some kind of massive manufacturing resurrection in the US, in Germany, even in China, is probably not true. That technology continues to improve, and it's easier for our technologies to improve in making things rather than in services. And so I think the simple answer to your question is no, this is not going to be effective.
Thank you. So I'd like to talk about the stock market a little bit, and Steve, you've been a little critical of the Trump administration, but the financial markets have been strong and stock prices have had record highs over the past few months. And so are you surprised by the strength of the markets? Do you think this is a backdoor recession, or are you wrong about your criticism?
Well, I could be wrong.
Can all the things be true?
I mean, the world, I think 44 years, wherever Andrew is, I'm going to correct him, it's 44, not 43. 44 years of economics, if it's taught me anything, it's that we have to be very humble in terms of what we can predict, what we can't predict. I have a forecaster to my left who might want to push back on that a little bit. But broadly, I mean, I find the stock prices a bit surprising given the uncertainty and things like that. The price earnings ratios are high. But I suppose what I would say is that some of the things that might be more negative for the economy and for the average kind of middle-class consumer as a whole might not be so bad for profits. We did get a corporate tax cut. I mean, that was kind of expected. I don't think that they would extend the tax cuts that were passed in the first Trump administration. It's not particularly surprising, but it came through. So I think in the broad sense, profitability may stay pretty high. The tariff effects, as Chris said, companies become more flexible at dealing with them and could maintain the margins. So I'd be the last person to predict what's going to happen in the stock market. I think there is, if you read the financial press, I read the Wall Street Journal every day, you get a sense of a certain precariousness of the current price earnings ratio, but there's a sense of, but if it's going to go up tomorrow, I'm not going to get out today. And so I don't see people running out to go and contact their broker to change anything at this point.
Yeah, I would say I think the two factors that we can point to support stock prices are the extension of the corporate tax cuts that were in Trump 1. And the other is the fact that the dollar has declined. So that means foreign earnings that are booked, on domestic P&Ls are now revalued higher with the dollar decline. And both of those factors work in the direction of stronger earnings and a stronger after-tax earnings and a higher stock market. It doesn't explain the higher PEs, which I think is just a kind of not irrational exuberance, but certainly an exuberance that is kind of pushing the limits.
I have two more questions, but if you all want to start lining up, please feel free. Again, Mike to my left and my right. I don't know if I did that correctly. So I know you just said you don't want to predict the future, but I would like you to. So in thinking about the current trends, what does the economic outlook for 2026 and beyond look like? And what is the biggest known unknown, would you say? I sound like Don Rumsfeld, so yes, not the biggest known unknown. Or unknown known,
Forecaster, want to start?
yes.
No?
Go ahead.
Yeah, well, I mean, if we look at the longer term, and the population numbers that Chris showed are important in this sense. And some say, well, okay, if we have fewer immigrants, we have fewer people, so we'll have slower economic growth. But after all, maybe we don't care so much about that because we only care about, our actual citizens in this context. But when, we have faster labor force growth, it's not just the possibly immigrant labor that's benefiting from that, but they're working in firms, and those firms are earning profits, and they're hiring other domestic people, and they're moving further, and these people are purchasing goods and services in their communities, and so I think that the faster population growth will actually not only raise overall economic growth, which is kind of obvious, but also per capita economic growth. And so I think that the pushback against immigration will slow things down. Economists emphasize that standards of living over the longer term are driven primarily by productivity of labor. And where does that productivity of labor come from? I could talk for several hours about that issue and my own views on it, which are actually somewhat non-standard. But broadly speaking, we need to see technological improvements. And where does that come from? It comes from research and development. It comes from implementing these new technologies and new ideas. And it's very disturbing in terms of the longer run prospects to see the US government cutting back on science and technology and hammering universities over their gripes about some of the social policies that they see here, and maybe we do need some reforms and we need to kind of examine ourselves, but broadly speaking, universities are a source of a lot of the new ideas that find their way into new technologies and find their way into economic growth. And so I'd be somewhat concerned about that. So, I mean, the US economy is a juggernaut. I mean, there's all sorts of things going here, and you can overemphasize the importance of economic policy in thinking what's happened. But at the margin, I see these policies as being not only somewhat of a concern in the short run, but also over the long horizon.
And it's not only the numbers on immigration that matter for economic growth, but the fact that immigrants also contribute in ways that domestic residents do not.
Right.
So, for example, immigrants have a much higher propensity to earn patents than do domestic-born citizens. Secondly, because we don't have enough STEM-trained folks to take jobs in technology firms, we need to have more highly educated immigrants come in to take those positions. And it's one of the reasons why tech companies, have lobbied fairly strongly against some of these restrictions.
Right.
And of course, other occupations as well at the lower end of the pay scale. When immigrants come in and take those jobs, they allow residents to move into more highly valued positions where they can contribute more. And those are the reasons why you get not only faster growth because of the numbers, but because productivity overall goes up.
All right, I'm going to wait on my last question because I know we have a few. So please go ahead and then I'll go over to you. Yeah.
Good idea.
Yeah.
Pick your best one.
There was a chart shown earlier where you showed a substitution chart rate, was also getting pregnancy replacing
Well, it's being sort of, you can think of it as being pulled upward towards the red line because those are the actual tariffs that are imposed. Now, over time, in our forecast, we have it reaching a peak of around 17% and then gradually declining as there's further rejiggering of supply chain. So the approach to the peak is slowed relative to the red line because of the ability to do some substitution early on and because of those free trade areas. And then you exhaust as much as you can in the short run, and then you've got the longer supply chain adjustments that that occur over longer periods of time, and then it will eventually go down. But yeah, it's basically being pulled up because as those new higher ones are being announced, more and more goods are being subject to the tariffs.
I'm actually looking at Chris's slide. I think it's kind of the free trade zone point you make, but that there was a lot of front loading of bringing in imported goods before the tariffs went up, and what you're seeing here is the actual tariffs paid, divided by the total amount of imports, and so I think that probably helped keep those rates down lower.
I should also add, just because you brought up something, we will have a reception after, and they will also be available for more questions, but in the meantime.
Yeah, thank you very much. Bringing these about
Well, it was Mike Faulkender, who was briefly a faculty member here at Washington University. He moved on to Maryland, and he was Deputy Secretary of Treasury for about 4 months. And I suppose he got fed up and went back to Maryland. So that's about it.
Yeah, I agree. Kevin Hassett, the chair of
Yeah.
the Council of Economic Advisors, was an economist, has written some nice papers on tax policy and things like that. Actually, it's a co-author of one of my co-authors, and I met him, some years ago, and but he seems to have completely, bought in on the Trump agenda without any public pushback, and apparently he's lobbying to be the next chair of the Federal Reserve, which is makes one swallow pretty hard, considering where the public positions that he's taken.
And one more, I think Scott Bessent has helped around the edges as well, the Treasury Secretary. Yep.
Thank you. Great question. Go ahead.
Under the circumstances, why would the Fed stronger again, but yet instead
I think a lot of it has to do with the uncertainty issue, broadly speaking, that when the rest of the world looks at the United States, they just don't know what's going on anymore. They don't know what they can trust. And as a result, there's a sense, as I mentioned earlier, about decoupling from the U.S., which goes back to actually another angle on Elizabeth's earlier question regarding the longer term. If you're the European Union or Australia or Japan or Canada or Mexico, what's going on? And you could say, well, there's some pushback. Now the Democrats had a good day last Tuesday, and so maybe this will go back. But we as a country elected Donald Trump president. He wasn't shy about saying what he would do. Maybe we didn't really believe it, but he's doing what he said he would do. And could that happen again? So that's a rather more of a kind of historical narrative discussion than a quantitative economic discussion on the nuances of foreign exchange markets. But broadly speaking, it just seems like less there. I don't know if Chris wants to add to that.
certainty, though, I would think would also trade into the stock market so far, but it hasn't priced across our should we not say that
Actually, I should say that you just triggered me in something that I should have said early on. It is very early in this process. I mean, some of these things take time to play out in terms of how things are going to happen. And so despite the big headlines every day about what's going on in economic policy, it's going to, some of these things are longer term, slower processes. So I think in that sense, we need to see what's going on. So I said what I had to say about the stock market earlier. I don't really have anything to add.
Chris, go ahead.
Thank you all for the presentation. So, I'm not mentioning I was just the course that potentially this one should get out of the stuff as so, given our critical answers in the White House. Just with that, where they would come just with them. And speaking of trust, mentions like this, I know at this point that they're really in a competition, they're really in a voters' as otherwise. So, ask people in Congress, they're about to take for giving up your trust.
I'll address the last part. I don't think that there is an ability to cook the books. The agencies have large, deep professional staffs with, very long tenure. There would be whistleblowing all over the place if the directors of the agencies came in at the end and tried to cook the books. I just don't see that happening. Maybe I'm naive, but I don't see that happening.
I guess I'm a little more pessimistic. I feel like, I agree with Chris about the professionality of the Bureau of Labor Statistics, the census, the CBO, the various kind of data creating agencies in our federal government. These people take what they do very, very seriously. I mean, I've actually had reason to dig a little bit into how the numbers are produced, and it's really quite impressive. Like the Consumer Price Index is the result of people going into stores and looking at prices all over the country. I had a mother of a student years ago who did this in the middle of Iowa, was looking at prices to get the CPI right. So they're doing I think an excellent job. My pessimism would though come with, if the data are not favorable to the Trump administration, he can try to cut these agencies off at the knees by cutting funding, by firing competent leaders, and we saw a little bit of this in the public health side already, and this could spill over and so it may not be that the data are literally cooked, but we don't get the numbers, we lose some of the things, and so that would be unfortunate. Yes.
Thank you. This will be our last question.
Yes. First of all, agree with the stock. The index the better. I just feel all the things stand on constant self self with all this young
Well, I can give a first, that's a big question, and in the broad sense, it is too early, and once again, you have to be a bit humble in terms of trying to make predictions about these things. But I mean, in the broad sense, technological changes that have raised labor productivity have been good for us. We would not have the standards of living we have today with the productivity levels we had 20 or 30 years ago, despite the disruption that they create. In fact, I was in this room speaking about the Great Recession many years ago, and I was talking about Hyman Minsky, whose dissertation advisor was Joseph Schumpeter, who was famous for the concept of creative destruction, which says the way, in some sense, we grow is by new things pushing out the old things. And actually, the Nobel Prize this year was for that kind of process. Philippe Aghion and Peter Howard, in particular, who have kind of talked about creative destruction as the process that goes. So it could be very painful in some sense going forward, and I suspect you're going to see that with AI, that there will be some kinds of jobs that will be taken over there, and that will be hard, just like the globalization was hard on many of our manufacturing centers over the last several decades. And so it's going to be kind of a rough process, but over time, I would expect productivity to rise. You mentioned about the electricity issues, though, and the energy issues. And of course, I think this is a concern that obviously people are seeing their electricity prices up high. And now I think there's some debate about how much of that is about AI, but certainly that's a possibility with the demands that they're making. There's an environmental concern about these data centers and the electricity and energy and water that they're using in some respects. And in that sense, the turn in this administration away from renewable energy, electricity in particular, makes those concerns greater. So that's kind of the two-handed economist, right? On the one hand, on the other hand.
So I would separate out the stock market effects of the AI boom versus the investment effects, the real investment effects of the AI boom. So with respect to the stock market, this is really different than the dot-com boom in the sense that these firms are funding these investments out of free cash flow for the most part, and only recently have started to look to debt to pay for this. So that's a really important difference. And they're part of larger companies that have revenue, as opposed to many of the dot-com firms had no revenue while their valuations were absolutely astronomical. So that's a key difference. On the investment side, I think, and related to this is, the magnitude of these investments are absolutely unprecedented to be this concentrated in one industry in peacetime. And the question of and so forth, the ramp up in the earnings that are going to be necessary to validate these investments is also absolutely unprecedented. And it remains to be seen whether that will be forthcoming. Now, so what might happen is there'll be a shakeout. Some of these firms will survive and prosper, and some of them will go by the wayside. The investments will still be there, and presumably once the losses are taken by the original investors, the price of that capital will get to a rate in which there is a positive rate of return. So the capital will remain, and it will be part of what helps to drive our economy forward. Personally, I expect AI to lead to very dramatic increases in productivity across the board. You marry it with robotics, and all of us are basically irrelevant. So I'm a pessimist on the labor market. Frankly, I think that so many jobs will, in fact, go away, and it'll be very difficult for people losing those white-collar jobs to find new jobs that they will do. And, I say this, my kids, one of my favorite movies I showed my kids is the movie WALL-E. And if you haven't seen WALL-E, I'll just skip to the end. It ends up, it's a dystopian future where people have been replaced by smart robots, and they have nothing to do. They float around in inner tubes and drink Mai Tais all day. That's not how I want to live my life, but I have a feeling that that's where we're headed. The robots will do everything for us, and we'll be floating around on inner tubes in the swimming pool.
On that note, thank you all for being here. Just a couple quick things. This actually is our last formal program of the fall semester, and it was very fitting to do it on the economy and with Steve and with Chris. While it's not a formal academic program, our funnest program is on December 3rd. It's our holiday party at the St. Louis Club. You are all warmly invited. Details are on our website, and it's on the back of your program and on our flyer. And so as the semester is coming to a close, indulge me for a moment. I really would like to thank our director, Andrew Reeves, and our administrative assistant, Elena Bain. They work very hard on these events. It is a lot of work brainstorming them, putting them together, having people come talk, ensuring that everything is fair and balanced and thought-provoking and interesting. And so it's a delight to work with both of them, and I'm grateful to do this work with them. I'd also personally like to thank my husband, Ian, who's a combat veteran. I love you very much. I'm thankful for you. And as I mentioned, we are having a reception. It is out these doors and to the right, and so Alana can show you where that is. Please join me one more time in thanking Steve and Chris. And thanks for being here. Okay.